people would approach me and say like, you should just stay focused on your own brand. And what I was telling them, I think I learned this from our podcast, just this idea of optionality. I thought, you guys don't get it. I don't care if this brand grows. If it just does what it's doing, then like, great, we win. So this idea like, hey, you can kind of take that revenue and reallocate it how you want to. It's kind of what Buffett does at the end of the day, right? As a capital allocator.
Welcome to The Investors Podcast. And this is a special episode only being featured here on our YouTube channel. And we have Trey with us here today. Trey, how are you?
Great, Stig. I'm excited to chat with you today. Thanks for having me on.
Yeah, I'm very excited too. And I just introduced you as Trey because I'm sure the audience know that by now. And we're going to talk about your company, Better Boots. But most of our viewers know you as Trey Lockerbie, the podcast host. So I guess I just want to ask you, how are you? I'm sure the viewers want to know that.
I'm good. I've been busy. A lot of people reached out wondering, why I wasn't hosting the show anymore. And there's some big news around that I'm excited to share more about. I took a bit of a hiatus there. I had to focus on this acquisition that we just closed, and I can talk about all the many reasons we did that and how the show kind of helped me do that. But I've been definitely busy. It's funny, the deal, I thought I was going to do a Warren Buffett sort of handshake deal, 30 days and close. Even Andrew Wilkinson, some of the other guys we interviewed, somehow they do this. Mine took 6 months. I don't know how, but it took a lot longer than you thought. But ultimately, I learned a lot, and I'm excited to share.
And I love that you say that, Trey. We all read that, or I'm sure some of yours have read about, how Buffett met this deal with the Nebraska Furniture Mart. The back of the envelope thing, handshake, and then I think he just asked Ruth Blumkin like some financial questions and got a response. He was like, yes, I think it was like 40 million, whatever. And you kind of like feel that's the way to do business. And then whenever you sort of like see how it's done, you're like, wow, that's slow and tedious. How you actually do that in real life. It's not the same romantic type of thing that you sort of like imagine that Buffett would be doing.
Absolutely. And I've been thinking a lot about this actually, Stig, because I was thinking, as it kind of dragged on and on, I was thinking, why can't we get this done sooner? And a big part of it, in a way, is something I realized is that once the lawyers get involved, in a way, they're kind of like insurance salesmen, because they are telling you all the things that might possibly go wrong that you need to protect yourself from, and because I have shareholders, and Buffett did too, so I don't know if it's exactly the right point here, but I started thinking about Brent Beshore and other folks that we interviewed who own 100% of their entity, or at least did for in the early days, and maybe they were able to take on more risk, because of that. Because once you get, when I'm approaching it and I'm thinking about my shareholders and people like that who are invested in it, you get a lot more, cautious, I guess, and you start listening a little bit more. Whereas maybe if I had more clout, or I just had more ownership and all that, I would have been like, I'm good with the risk. Let's run with it.
Let's do it. All right. So Trey, perhaps we should say, first things first. So really, the premise for today's episode is that we're going to talk about acquiring another company, which was what you were alluding to before, but also operating a successful private company. And we're going to talk about the company you co-founded with your wife back in 2012. And I'm going to ask you a very big question here, because could you take the viewer with you on this journey from the early days of Better Boots and perhaps up to today, or to the acquisition we're going to talk about later?
Yeah, a lot of people ask me why kombucha, and especially given my prior background, which was as a touring musician. I was on stage in front of 10,000 people playing guitar, and realizing kind of my dream of being a touring musician, and looking out on the crowd and realizing that I just felt no connection to them. And there were so many people actually that it kind of just felt like a TV screen. And that was a big moment for me, because so much of touring is lonely. You're just traveling, you're in a hotel room, you're on a bus, on a plane, and you kind of just are constantly, not making connections or really meaningful ones. And so to not have that connection on stage, given it wasn't my music at the time, it was someone else's, and maybe that's a big factor. But for me, it was sort of this moment of being like, okay, maybe there's something else I should look into doing. And that was right about the time my sister was diagnosed with breast cancer at Brittany at age 24, which really threw me for a loop. It really made me prioritize my health and want to get healthier. And she said, you should be drinking this kombucha stuff, and it's really good for you. And I went out and I tasted it, and I really hated it actually, which is the ironic part. It was very polarizing at the time, very vinegary and very sour. And when I met my now wife, she had just come to the same conclusion I did. But she was touring with Rihanna, flying on private jets. So it really doesn't matter kind of the level at which we were touring. We came to the same conclusion. We both wanted to pivot our careers, look for something else. And this beverage was so fascinating to me because, at the time, people didn't know why it was making them feel better. They just knew that it was. And that was really intriguing to me. And so we started brewing it ourselves. We brought it to the farmers markets. We started a very grassroots way, just selling it at farmers markets, and kind of selling out, and then going to buy more materials, showing back up again. And it just snowballed from there, to use that kind of Warren Buffett analogy. And so it's really become a national brand now, which is kind of amazing to us because it far exceeded our early aspirations for the business. And now my sister Brittany is our biggest customer. So it's all worked out really well.
That's just a wonderful story, and I love hearing these entrepreneurial stories of how you set out to do something that, and what happened was very different than what ended up happening, which I guess is not just the way of running a company; it's probably just life in general. If you knew where you would end today, would you have done this same thing over again?
You know, in a way, um, I did know where I was going to end up, in that I had this vision of, it's so funny. I think the grass is just always greener. I thought I would love being a touring musician, and I did. It's very much an early, young man's game. But I had this vision of just like driving home from my office, like having an office just seemed like this novel idea. And it's so funny to think about, because now when I think about what was motivating me, like being able to stay home with my two kids and raise a family, and um go to work and have something physical to like show people, enjoy with people. Because that's the other thing about touring. There's nothing tangible about it. You get home after a year of touring and you've got nothing to show for it. You can't say, what have you been up to? It's like, oh, here's this, check this out, taste this. That you don't have that. So in a way, like that, those were the things I was chasing early on. I didn't expect it to get, as successful as it did, but I'm still kind of living that, I guess, more humble aspiration of just getting up, going to work, being able to come home and enjoy my kids and be with my family. So in a way, that's come together for me.
That's wonderful to hear, Trey. And if we can talk a bit more about the business model of Better Booch, and please feel free to be as transparent or non-transparent as you want. As always, Trey, we had a lot of conversation on and off, the recorder here at TIP, and I know a lot of companies, especially whenever that was a lot cheaper than it is today, they had that's called a tolerance for being unprofitable for a period of time, and I think most companies probably start off as somewhat unprofitable. Let's say that you start a restaurant, you still have to, you have some expenses that you need to put down there, but there are also other businesses that are funded, say, by venture capital, and venture capital companies don't have any intention of the company being profitable like within a year or two or anything like that. The strategy is to grow fast, and then something wonderful happens. You might be sold, or you might be profitable at that point in time. But I was curious to hear, how does that framework sort of like fit into Better Boots? Like, what was the strategy in terms of being profitable? Can you even talk about that as a strategy, and perhaps some of the pros and cons about doing one versus the other?
Oh yeah, I have a lot of thoughts around this. I mean, first of all, I think there's been a huge shift in a number of industries, not just beverage, but I think people have maybe they were always like this, which is why Buffett is so successful. But he was, he's always been that value investor who's very patient, whereas he's just surrounded by these momentum traders. And I think what's happened is, um, in a way, I have this analogy where Bruce Springsteen, Born to Run, that was his third album, and that's the one that really took off. And that was at a time when record labels would sign an artist and develop them or like invest in them. Hey, you got a couple of flops under your belt, like no problem. Like we believe in you, like we really, and then it paid off. But today in the music industry, for example, I heard this saying, sign the audience, not the artist, because now you've got people who've got 10 million viewers on TikTok, and who cares if they can sing or whatever, they've got a following and they've got this data, this distribution platform already built in. And that's how the world has shifted in my mind. And it's the same with food and beverage, and back in the day, I look at Bragg's apple cider vinegar or some of these products who I don't know anything about their early days, but they've been around forever. And you just have to imagine that there was a time where these grocery stores weren't so data dependent and they were letting these brands sort of just blossom and grow over time and find their following. Whereas now it's much more cutthroat. It's data driven real estate game. Get on shelf, and if you don't perform within a few weeks, hey, you're off a shelf. We're going to replace you with somebody else. This is the Amazon buying Whole Foods, new world we're in. So to answer your question, I think getting either profitable or raising venture capital becomes that much more important, and you have to decide, because you can be profitable and, in my experience, much smaller. But in food and beverage, you cap out because there are these step functions involved where it's all about scale at the end of the day, where you're selling $1-2 drinks, you got to sell a lot of them. And you'll have someone like a Whole Foods or a Walmart or a Kroger come and say, hey, we want to carry you. It's 1,000 more stores for you. So all of a sudden you've got to take the step function and scale up to fulfill those orders, because the biggest sin is not being able to fulfill. So to finance those step functions, I mean, it's either that you say no and you just kind of always stay small to some degree, until I guess you just build up such a bank account where you can do some capex that you need at that point, or you take outside capital. So we ran into that fork in the road a couple of times with Better Booch. We set out to be a family business to kind of grow organically, and we did for about almost 7 years. And then eventually we got, this curse of success in a way, where big stores came to us and said, hey, we want to carry your stuff. And so we had to make a decision. Hey, do we want to say no here? Do we want to take outside capital to finance this? And that was at the time where, I'd read enough Buffett, and I was kind of eager to get the experience under my belt of having shareholders and taking on investment and being accountable to other people, and having a board and all these things, that I just wanted to experience. So it's hard to say. I think if you're just selling goods online, I think there's a lot more customer kind of financing you can do. But when you're making like physical goods and distributing them to retail and these other things, there's some real costs that are involved, and that takes financing. So, in a way, I think the world has changed and kind of catered more towards needing financing. And at the same time, I think that the grow at all costs, which I think you also alluded to, has shifted in a major way again, just in the last couple of years, with interest rates going back up. That ZERP era we were in, with money being so cheap, and you had what they call now tourist capital, right, coming into places like food and beverage and financing any brand that showed any sign of success, because the idea was, hey, it gets big enough, then Coke or Pepsi buys it, one of these conglomerates buys it, who cares if it's profitable? We can plug it into something else and make it profitable. And I think that is in some ways still intact, because that's kind of how we approach the acquisition I'm going to talk about. But at the same time, you're not seeing that same kind of tourist capital coming in and money just sort of flooding into this market to have brands grow at all costs. Now, every brand I see is much more focused on profitability and trying to exit based off a multiple of EBITDA, say, versus revenue.
It's interesting you say that, because, for example, whenever we look at the landscape here at TIP, it's we don't have any barriers of entry in podcasting. You know, everyone can start a podcast on their phone, and in a way, that's obviously painful because then there is more competition. You drive down margins and all of that. Um, and we see that a lot with intangible products because it's getting cheaper and cheaper to sell intangible products because of the internet, and cost of data, processing power, and all of that. And then so that's hard. And then you look at a business like Better Boots, and you need a lot of capital, which provides some barriers of entry. But you also have to deal with like raising capital, which of course can be a good experience, but like you have to deal with that and have a board and like take on that capital and take a different type of risk. Of course, there's also different type of rewards with that, and that's also hard. And so it's one of those things that's raise capital, that's hard. Don't risk capital, that's also hard. Choose your hard.
Choose your hard. Amen. I mean, that's definitely a philosophy I've come to realize is choose your hard. Yeah, it's really, and I think to your point about digital goods and digital services and things like that, there are definitely other roadmaps. But to create physical goods and ship them, it's a whole other beast.
And you decided to focus on size. And on that note, you recently acquired Live Soda. So I guess my first question to that acquisition would be, how did you identify the target?
Yeah, so going into this year, I had a sense of how it was going to play out just from talking with all the folks we had on the show, right? Painting this macro picture, it was fairly clear, like, hey, inflation's not going away, interest is going to keep going up, capital's probably going to dry up. There's a real fundamental shift happening underneath, and I think we need to be prepared for that. So my mind was already open to it, looking down the next 12 months for Better Booch and saying, okay, there might not be any new distribution or as much of it as there was. There might not be the same kind of initiatives we can invest in or want to invest in for marketing, et cetera. So maybe we need to be more conservative on our projections, for that brand. And around January, I was actually approached by, Live Soda. They were going to market to kind of to sell, and it was owned by this family office. And a number, for a number of reasons, that the family office is actually also shutting down and folding down and stuff. So there was a few other reasons for them to sell, but they approached me, and at first I was immediately like, skeptical of it, but I was also, I guess, more open-minded to it. I went back to my wife and said, I think we might want to do this. And she was like, why? Are you crazy? Because they're a similar size company to us. They're actually almost identical in size, and in a way, just sort of one of our closest competitors. So it seemed outlandish, A, that we could acquire them, and B, that we would want to, because in a way, having them die is nothing but a good thing, for our brand, theoretically, right? So, but when you looked at it, the two businesses on paper, going back to that scale component, I started to quickly realize that they were almost a mirror image of us. And that's, at the current scale, it's hard to sustain. We were running a deficit, and because we're manufacturing ourselves, and that's a huge cost. They were doing the same thing. So the idea was, hey, what if, we just pull that brand in-house? We don't necessarily need their operation. That would cut 60% of their OpEx and be accretive revenue to us and get us to profitability and all these things we're prioritizing this year. And anyway, set the stage. So I kept my eye on it. I had a good sense that it was a tough sell, because unless you've got an entrepreneurial type that wants to go in there and do a turnaround, it wasn't going to sell off of too small to kind of sell off revenue, too small, not making money to sell off EBITDA, et cetera. So I kept my eye on it. So around May, I knew their lease was coming up in June, July. So we approached it in May, thinking, okay, they're getting down to the wire here, and we cut a deal, and yeah, we can talk more about how it unfolded from there. But in a way, I think doing this podcast actually is what opened up my mind to this model. Because of something else I found interesting was people would approach me and say, like, well, why you should just stay focused on your own brand. And what I was telling them Um, I think I learned this from our podcast, just this idea of optionality. I thought, you guys don't get it. I don't care if this brand grows. If it just does what it's doing, then like great, we win. Like if it's a regional brand doing, 5-6 million in revenue, and if we can keep it there doing that, great, and if Better Booch continues to become the national, international brand we all hope it will be, then great, But so this idea, like, hey, you can kind of take that revenue and reallocate it how you want to and prioritize things over others. I mean, it's kind of what Buffett does at the end of the day, right? As a capital allocator, he's saying which of my companies need this capital, and the most deserving ones get it.
Wow, so it was quite a significant acquisition. You said it was similar size as Better Boots, and so how did you value it? How did you finance it?
Yeah, well, we didn't have a ton of liquidity, so it was always sort of going to be a stock deal, and that's what it ended up being. And how did I value it? So, well, for one, I went into it thinking a lot about margin of safety. Um, I loved this quote from Buffett that Brent Beshore brought up from his dinner he had with him, where he said, "Price is my due diligence." So I knew that like the price had to be low enough to mitigate as much risk as humanly possible. And I know that Buffett rule of thumb, is usually, at least it used to be, who knows what it is today, but I know he would always try to target around 50% of what he thought the intrinsic value would be. So in this case, we were looking at the revenue, not we're at least discounting that by half, right? And just saying, hey, we're not going to expect it to continue to do what it's doing. Let's at least expect that it's going to do half of what it's been doing. And that's actually something Sam Zell brought out in his deals as well during our interviews. I remember him mentioning that kind of 50% number. So that's immediately how we kind of valued it to start.
Hey everyone, I just wanted to take a quick moment here to tell you about this premium superfood shake I have recently fell in love with called Ka'Chava. Ka'Chava is made from plant-based ingredients to power everything you do and help you feel amazing. In every serving, you get a balanced blend of superfoods, nutrients, plant-based protein, adaptogens, antioxidants, and so much more. As if that wasn't enough, Ka'Chava also tastes amazing, and it's helped them earn tens of thousands of 5-star reviews. It's creamy, smooth, and it comes in these 5 delicious flavors. To make it, all you have to do is add water and a little bit of ice with 2 heaping scoops of your favorite flavor. Then shake it or blend it and have it ready in seconds. Personally, I like to drink Ka'Chava as a quick and easy breakfast, or even as an afternoon snack when I'm craving something healthy to help me fuel my workday. I'd encourage you to give it a shot too, because they have a love it guarantee, meaning that if you don't love it for any reason, you can just get your money back. We Study Billionaires is thrilled to partner with Ka'Chava as they're offering our listeners 10% off for a limited time. Just go to kachava.com/WSB. That's spelled KACHAVA and get 10% off your first order. That's kachava.com/WSB.
And then there became that funny game of, doing a stock deal and saying, "Hey, our baby is much prettier than your baby." We're gonna
Right.
when we're the same size.
Super unbiased.
And so those were interesting conversations, right? But funny enough, and this is something that I think is just something to call out. Is we got a much better deal than I even originally proposed. So what was interesting is, as we got into the LOI and we got into the deal, their manufacturing arm sort of broke down. The capping machine actually broke down on their bottling line, and that's a big capex expense, right? And they're thinking, well, hey, we're either selling this thing or we're going to shut it down, so we're not going to spend into this. So we were actually able to step in and do an interim production agreement where we said, hey, we're going to take on the production of the product, and kind of just, operate in good faith from there, that we're going to close this deal. But it allowed us to negotiate a much lower number from that point, because, we had pretty much all the leverage to keep the brand alive from that point on, in a way. And so why I bring that up is because, that cut the cost down considerably. But there were moments of time throughout the following months where we came to situations where, um, the brand needed our support in other ways, and we said, okay, we can probably knock another point or two off of this deal again. And one of my board members who's heavily experienced in private equity, et cetera, he put his foot down, and I haven't seen him put his foot down on like too many things where he was more ultimatum about it. But this was he was very much like, no, we're not going to do that. We're not going to go to the table and discount this deal anymore. I feel very strongly about this. And at the time, that really surprised me, right? Because I'm like, don't you just want the lowest price possible? And again, going back to the Brent Beshore conversation, which I think a lot about for this context, he said, yeah, you can get the lowest price possible, but the other side's not going to be happy, on the other side of the deal. And you're entering in sort of a marriage in a way, right? You're entering into a relationship going forward. You want everyone to be happy, and you want to have a good deal. And you want to feel like you both gave up a little bit of something, right? For it to be a good deal. So I brought that up because that was a big learning, I think, through the process of saying, there is a balance. You want to get the lowest price possible. You want to mitigate as much risk as possible, but you also want to be mindful of the shareholders and the people on the other side of the deal and how the deal continues on from here on out. Because again, this is something we're not looking to flip and sell. This is something we're looking to own forever.
Yeah, and I think perhaps one way that the viewer who might not have the same experience as you have in terms of making that type of deal, it's the case for most things in life. You might be speaking with your employer about getting a raise, and how do you feel if your employer keeps on saying no? Like they might be, getting their way like short term because you can't find another job next day, but you're gonna create resentment and all kinds of stuff down the road. So you want to make a deal that everyone's is happy about, and of course it has to reflect, perhaps in this case, a motivated seller. It has to reflect the realities, but going forward, sort of like to kill your opponent is typically a very bad strategy, especially if you're going to look at each other the next day, which seems to be the case here. Can I ask, Trey, how did your board look before and after the acquisition of Life Soda?
Yeah, what's funny about that, I think, is they thought I was crazy, right? When I first brought it to the table, they invested in Better Booch. They believe in that brand, and they were very much like, why are we even talking about this other brand? And by the end of it, they were drinking Live Soda on our calls. They were really enthusiastic about it, and they've kind of flipped the script on it. And same with my even team here. And I think in a way that's what you want. You want people to be skeptical up front. That's why you have a board. You want them to question your decisions, but also you want a board that trusts you enough to say, okay, more about this, and I trust you that this is the right decision. And we all think it is now. And I think that was they saw, and I think what wasn't clear maybe to most up front is just how synergistic that business is to our own. That's another kind of point to call out when you're looking at deals. It's not just putting two things together. You have to find synergies and find a complementary component to bolt on. And I think that's what we found here. So by the end of it, they're completely on board and supportive of it, and even enthusiastic about it.
So did they get bought seats or only shares?
No, just only shares. In fact, common stock. So not even preferred shares. Something our board and other investors were, I think, very happy about. Something that we didn't give up a lot of control, just the ownership stake.
That's interesting. And perhaps you can just briefly, whenever say, oh, just preferred shares, it's preferred shares is probably not known too often, but in this type of deals with private companies, they're actually quite often used. So perhaps you could talk about what's the difference between common stock and preferred.
Yeah, I mean, preferred usually just comes with a lot more rights, is the best word to kind of put towards it. So I remember this Carl Icahn quote where he says, your price, my terms. And so,
Right.
meaning, what rights do I get? So for example, a preferred shareholder is probably going to get paid out first. They have sort of this first position on the assets, should the business go under, for example. Or it could be that, hey, I'm going to get 2 or 3x my investment before anybody sees any other money, um, upon an acquisition, for example. So there's all kinds of things like that. There could be terms that say, hey, you can go and raise more money, but I'm not going to get diluted. There could be it's all terms like that.
Yeah.
I mean, there's a whole book about all these terms. Brad Feld wrote a great book about it. So that's a whole other education in and of itself. But I always think of that Carl Icahn quote. I think it's so good.
Yeah, I'm real happy that you mentioned that, because it's so easy to look at X million dollars, but there are so many other things, and one of the masters of that is Warren Buffett. Like, so many deals, he's getting preferred shares, so he's getting his 9% dividend while he's waiting, and like all of these lucrative terms. So it's not just like the price or sort of like the headline, like all the other terms. So sort of like to your point about Icon's quote.
Yeah, and I would say just on that point, for those watching and interested in this, I mean, common stock. I think you're often told that you need to give up preferred shares at some points, but I've actually seen now an example where a friend of mine is running a company that raised nearly $100 million from one of the biggest strategics in their industry, and only gave them common stock. I just thought, wow, it can be done. As far as so when you're approaching this, just understand that it's not you don't necessarily have to give up preferred all the time.
No, and I think the Feldman book is one of the best resources, if not the best resource. I read it after you recommended it to me. It's a great book in terms of like understanding how all these deals are structured, because you might be thinking that in a deal, like one party says 20 million, the other says 40, and they probably end at 30, but like there's just 100 different things, that is
Yeah.
that is, I would say, just as important as whether or not you end up with 20 or 40, whatever kind of number you end up with.
Yeah. And
Even though it might sound counterintuitive.
yeah, and something I think through this journey, I got a real education around what's important to us, especially around risk, et cetera. And I know that perhaps it does become a little bit easier, because once we've now invested in the legal and we got through this deal, part of me was like, oh, okay, I could almost just copy paste this deal over onto this thing. Like, I already know, now what's important to us. And so perhaps that's how people eventually get to those 30-day closes. They've just got, I remember even, I think Andrew and Brent talking about open sourcing their fund docs at one point, because it's just like, we've done all this work. We know what we want and what amount of risk we're willing to take for it.
Yeah. Yeah, and I don't think there's any reason not to be transparent about it. I mean, look at what Brent B. Shaw did with his book. Like, it's basically marketing material for please sell your company to us, and these are the terms.
Yeah.
It's I'm not going to make it sound like it's bad by any means. It's sort of like you're dating, which is more or less what you're doing whenever you're like finding a new company. You're saying like, this is what I'm looking for, right? Like, do you want to have kids? Do you don't want to have kids? Do you want to get married? It's sort of like, and there's so many different things. Like, do you want preferred? Like, I only do preferred deals. Okay, but then if you only want to take like preferred shares, then this deal is not for you. Great, you save time, I've saved time, lawyers fees, all of that. Fantastic. Let's move on to the next candidate. And it's so I actually think it's empowering. It's not the opposite by any means.
Yeah, you could say the same. I was going to say for Buffett's shareholder letters, or for the meeting in Omaha that he does. I mean, it's a big broadcast of, hey,
Right.
these are our principles, these are our values, and hey, if it sounds like it fits you, give us a call.
Yes. Trey, I can't help but continue talking about raising capital. I find that to be fascinating. What's the most important thing you learned about raising capital?
That it's a numbers game, and everyone I've talked to kind of says the same thing. And I say it's a numbers game because it's almost like baseball or something, where the greats are hitting at 0.2, 0.3, whatever it is. It's like it takes a lot to get that first check, and it's all about building momentum. But no one wants to be the first check into anything. I think there's this social proof element that is just inescapable. And I have seen, VCs and others who are incredibly bright do a good amount of diligence and then see one other firm say, no, we're out. And then they go, oh, we're out too. It's like without any second guessing, it's sort of like, it doesn't almost doesn't matter how much due diligence is done. The social proof element is so incredibly strong. So building up good affiliations. The other thing I've learned is that fundraising is constant if that's the route you're going, meaning even if you are not actively raising, you're keeping investors warm. One great practice I think we've developed and borrowed from somebody at some point was just having an investor centric newsletter. That was just as we're meeting investors and building kind of a database of folks who have expressed some interest, getting them on a newsletter, just keeping them warm on all the updates. Because I think investors, especially the first to come on board, they need time to get warm to the idea, to get comfortable with the idea, and seeing you kind of live up to your promises is a great way to build that trust and get that consistency that they're looking for. So I think in a way it's you're starting earlier than you think. It's ongoing even after you've raised. It's all about relationships, and I think that it's also a numbers game. I mean, for us to raise, the 10 plus million we've raised to date, I've probably spoken to 1,000 people, or something like that.
Wow.
I mean, it's really a constant, development. And one thing I would say too is through that experience, I've become very grateful for the early no's, the people who were like, no, not a fit for me. Because in this last year, especially, I saw this with not just our company, but so many others. Investors just were so on the fence, but they didn't want to be out of the game. There is a lot of supposedly dry powder out there, but everyone was just a little too gun shy, and so there was this death by 1,000 maybes, is what I was calling it, where you're speaking with investors who are like, okay, well, let's talk again next month, and let's do this. And I think it's really important when you get to fundraising to setting a deadline and being very clear with the investors. Hey, we're accepting term sheets by this date. We're making a decision on this date. I'm available for the next 6 weeks for as much diligence as you want, but after that, the deal closes and that's it. So if you don't set those boundaries, it can just drag on, and investors want to just get as much information as they can without paying for it. So those are a lot of the tips and tricks I think I've learned over the years.
Yeah, because you're paying for it,
Right.
with your time. And I read this very morning that the founder of Peloton, before they IPO'd, he said that he probably spoke to 1,000 people. So he said, so like, same as what you're saying, but he said he's probably had 5,000 to 6,000 no's because he didn't get a lot of early no's. And so people just continue asking him questions, and he was like, could you just please give me an early no so I can spend my time on someone who wants to invest
Mhm.
instead of having 6 calls and then say no at the very end. So, and at some point in time, that company was valued at 50 billion, and I know that's not the case anymore, and it's not to draw too many parallels to Peloton, even though I'm sure you have it with a 50 billion
I take it.
valuation. But it sort of like goes to your point about you don't want to be the first. It's easy now to look at something like Peloton. You can see why they were so successful, especially during COVID. But like, if you're the first one who's getting a pitch, and you ask like, so who are the other investors? You're like, my mom and you. It's a tough sell for sure.
And it's so much easier, looking back. uh, you know, hindsight's always 2020, right? But I remember, just think about like Airbnb, for example, and investing in that when it was first pitched to you and saying, "Hey, we're going to open up our house and have strangers live in it." And how on earth could you possibly, get your head around that? But then looking back, you're like, oh, of course, like if I would have totally invested in Airbnb, like it had been pitched to me at that point. So that is the real skill and the real art is being early enough to say, hey, I'm gonna take a shot at this and being right.
Yeah, and that's also why that's where you make the money. But Trey, I'm curious to hear about the compensation. And I'm just gonna ask. We can end this out, or you can not respond, or whatever. But I know you have less than 50% of the voting rights, so you don't have control. So how's the compensation determined? Who determines that? Even I mean, you still have a lot of shares. So, do you have a say? How's the dynamic? How's the dynamic with
Well,
the board?
yeah, I think compensation, to me, the easiest way to look at it is just saying you can charge whatever you want as long as you earn it, right? Meaning, as long as you're creating that value and then some, I think you can kind of stand behind it. You don't often see it sustain very long if someone is demanding a high amount and not living up to the value. And so I think, for our experience, I wanted to kind of highlight something you said earlier around profitability, especially early on. I mean, we were profitable very early on, but I was also not paying myself a living wage. So it's like, so are
Right.
you really profitable or not? You have to kind of at some point insert yourself as the founder or the CEO in your own business and say, hey, look, I've got to make a living here, and I need to at least know that I'm creating enough value to pay for not only all of you, but me as well. And I think there's another component here that especially employees don't often recognize, and that is this idea of risk and reward, right? Like, as the founder or CEO of the company, I have taken on so much more risk than any other employee at this business. I've literally personally guaranteed millions of dollars of debt, for example, or on equipment financing and other initiatives we've done where because one thing I've learned about, there's no such thing as business credit. Usually it's just personal credit. Like, all
Oh
these
yeah,
people just
for
want
sure.
personal guarantees, so we've risked our own livelihood, and I mean, more times than I can count now. And so at a certain point, you have to understand that the reward has to be there as well, and that you have to sustain a living, throughout. So for us, and we do actually, my wife and I do control the board, and we do have enough shares to at least enough rights to set our own salaries. But we've brought it up, we've brought it back down. When COVID hit, we actually cut our salaries in half just to ensure that we could keep others employed. So we've done the things that, again, I think you got to do. It's a lever that we pull to ensure that we're taking care of ourselves, but also the rest of the company as well.
And so how does that work? Whenever you say, Trey, that you have control of the board, but you also own less than 50%, like how does that? Could you talk about that dynamic?
Yeah, I mean, there's all kinds of ways to do it. I think the most easy to understand is that the board members we have were actually elected by us. So they're called like open board members. So we didn't actually have an experience where someone wrote a check and said, hey, I demand a board seat. We actually voluntarily brought these people onto the board. So when you have that approach, you can structure it in different ways, where we say, we can fire these people from the board theoretically, if we wanted to. And so we maintain control. So that's not always the case. Sometimes if someone's writing a big check and demanding a board seat, that comes with their other terms that we kind of alluded to earlier. And that can make it a little bit, of a different situation. Luckily, by doing it the way we've done it, we've been able to take the people we wanted most to be on the board and put them on the board. And so they're all the people that we most respect and admire and we really value. And so it works out. Whereas, sometimes you're stuck with someone you don't really maybe want on your board. So it's something to be cognizant about, as you're raising money and again, look into those terms.
Yeah, and I think it's probably natural to think that if you own, I don't know, 25% of a company, you own 25% of the votes. But that's not the case, and it's or it can be the case, but it's not necessarily the case. And the same goes both for public companies, like a company like Alphabet, for example. The co-founders have more votes per share that
Mhm.
they own because they own a different class. And you can do something similar whenever you have a private company. It's about those terms that we talked about
That's exactly right.
before.
Yep, exactly right.
So Trey, you spoke with hundreds of successful people while hosting We Study Billionaires. I can't help but ask you, now that you run such a successful company, what did you learn about, let's call it, the formula for success? But speaking with all of these highly successful people.
Yeah, that's a great question. It's something I've been thinking about a lot. When I was going through not only the people we've interviewed, but the people we've studied just over the years, the things that really have stuck with me are there's a story about Howard Schultz that I just absolutely love. I can't remember where I came across it, but supposedly he was in town somewhere, walked into a random Starbucks with his friends, or not his, his colleagues, and I don't know, the S on the sign of Starbucks was burnt out, and they called out this experience because he didn't berate anybody, didn't get upset like, hey, why are we representing ourselves this way? He just looked to his colleagues and said like, hey, what's our system for sign replacement? you know and it's just what I've kind of uncovered in my own business is that every time there's an issue or there's a failure, it's actually like this beautiful opportunity for exposing where a system should exist. And so we have the saying at Better Booch, for example, where it's okay to make mistakes, you just can't make the same mistake twice. Right? Because you're inevitably going to make mistakes as you grow. That's kind of the whole point. I mean, I don't know if it was offline, but you called out Ray Dalio earlier, and he is all about this, right? All about learning from your mistakes, and that's actually what propels you to that next step. He's got this beautiful drawing about it. So it's this feedback loop where you fail, you learn, then you propel further, and that nothing could be truer, than running your own business. It's if you want to actually scale, you have to set up the business in a way where ideally it can run without you being there. You can afford to go on vacation, for example, and not expect it to fall apart. So that requires systems. So Howard Schultz, one of the billionaires that I've studied, and that always stood out to me. Sam Zell. I mean, what a magical interview that was. Days before his death, even, and just he was so nostalgic, and so much of that interview has stuck with me. One of the main things was this objectivity he brought to his deals. You could imagine he had this multi-billion-dollar real estate empire, and he was willing to just sell it because the price was right, and let it go. And it's easy to say, but like imagine not having your entire identity, ingrained, in that organization, and feeling like that's your legacy and that's your no, I'm going to pass this down and I'm going to do XYZ. So he was always sort of this fiduciary in a way, not only to his shareholders, but himself, where he would say, he wouldn't just give it up for nothing. He made sure it was a pretty astronomical price, actually. But it was sort of this idea that if you're not, it's kind of the price you're choosing every day. It's like that Mr. Market mentality where, hey, if Mr. Market shows up and offers you a certain price, you got to take it. Whereas if they offer you a low price, you don't have to take it. So it's this objectivity that really stuck with me. Buffett, obviously, there's so much there that we can unpack. The margin of safety, the circle of competence. That was another component that ties in really nicely to the acquisition we did. It was well within my circle of competence. Right? It was almost an identical beverage brand making a slightly different product. But I didn't go buy a supplement company. I didn't go buy it was something I very much understood and could plug in synergistically to our business. And pricing it in a certain way where it was mitigating enough risk. I had that margin of safety involved. I mean, I could go on and on, but these are some of the handful of things that have really stuck with me.
That's fantastic. And um, again, like you said there, Trey, there are so many things to unpack. And I think one of the things that I admire a lot of things about you, Trey, and you think so well about business, and I think that you're so right about this objectivity, which is something I think you had even before you joined JP, which is probably why you become so successful. Just one personal anecdote. We you got an offer on TIP at some point in time, and it was whenever credit was a lot more loose than today, and I could probably look at that valuation and say that we were offered more than we were worth. And I said no because I really like my job. And I don't think Samsel would say that, because it was all about the numbers. And I think you do that so well. And it's just very clear whenever you talk about it. Like, you're very good at saying, you talked about, for example, your own compensation, and how to, should we raise it? Should we lower it? How you think about the board, how you think about the terms. And I don't necessarily think there's a right way to do it, but I think it's very important that you were very conscious about your style. For example, we have something we call the mastermind community here on CIP, and one of them is a very successful entrepreneurs who made a lot of money in that, and he talks about why it's such a good idea to give your team options. And there was like this thing, it get vested over 4 years, and that's a very standard way of doing things, not because he came up with it. It's like, that's the way to do it, and that's why so many people do it. And I remember thinking, like, why would you ever sell your company? What? But here's the other thing: whenever you set up a good certain structure, if you're very conscious about it, and if you communicate it well, you attract the other people who think the same way as you. And if there was something you learn from running your own company, is that everyone needs to pull in the same direction, and it's more important than what direction you're pulling, because what's right for you might not be right for another company, but that everyone is aligned. And that's why you hear all this corporate mumbo jumbo about like values, and you're like, oh my god, like, who cares? But like, it's a thing. Like, there's a certain way you're doing things in certain companies, and not that it's one thing is better than the other. And you mentioned Redelio yourself. It's more important than everyone in the company does it the same way, and have a respect for that. And so I just wanted to, this is my long-winded way of giving you multiple compliments.
Yeah, no,
Trey. I don't know if
I'm not
if I came
undeserving,
across
and
the right way.
I appreciate that, Stig, so much. So thank you for the kind words. I'm actually going to quickly, highlight some points that you just made, but how you actually walk the talk. So, for example, the values thing. I've seen no one do this better than you. Where, for those who don't know, Stig runs TIP, and I even adopted this at Better Booch. He would do these weekly Slack updates for the whole company, giving a high level view of the company. But then in a Warren Buffett way, he would kind of go into these thoughts of the week in a way, here's what I'm thinking about. Here are some lessons I've learned. It could be either from his own experience or someone else's that he's been studying, and always hitting on the values. So, for example, radical transparency, something Ray Dalio has really promoted, something adopted at TIP. You've time and again expressed, ways of highlighting transparently what's going on in the company that builds trust, and also always doing it in a way that was sort of, hey, it's like Ted Lasso in a way, right? He's like, hey guys, we're down right now, right? It's the second half, we're down, but like, look, we got this. And always making the employee feel protected and thought of and valued, and saying, look, this is happening, but here's what I'm doing about it. So anyway, values are very important. Instilling them and repeating them is very important, and finding those who adopt them and subscribe to them, also very important.
Yeah, and if I could just, before transition, just have one quick remark to that. I think there is something to be said about that trust component. Whenever old friends catch up, sometimes it's like you're trying to pretend like everything is great, and you sort of like, because you want to say that everything's just so good, or perhaps you don't want to get it out. Whenever we jumped on this call, you're like, oh, how are you, Stig? I'm like, yeah, our revenue was just cut in half. That was sort of like the first thing that I said. But there's something to be said about whenever you have that type of trust with other people, and whenever you're very transparent about doing it, whenever things go well, but even more importantly, whenever things are not going as well, you attract people again with similar values as you, where you have this, in this case, value of radical transparency, or whatever it might be. Anyways, there was a personal anecdote.
No, I to that point, I was just gonna say, yeah, there's better questions, right? I just through interviews learning, like, how are you sleeping at night? is a good one, right? It just kind of cuts to the point of like, hey, how are you doing? It's like, no, how are you sleeping? Because I think it says so much more about what's really going on with people, and it's so easy to kind of gloss over the realities of what we're all going through, and miss those opportunities to connect, to really connect.
Well said, Trey. It's and especially whenever you're making yourself vulnerable. And we had Jesse Itzler on the show a long time ago, and I remember what he said because I asked him this question: if you could give yourself a piece of advice to whenever you were 20, what would it be? And he said, "Be vulnerable." And I remember whenever I asked him that question, it was just a long time ago now, and I certainly remember being 20. And if there was one thing I did not want to be, that was vulnerable. and and sort of like what you realize as you get older is that perhaps because you're more at peace with yourself, I think that's probably a component of it. But also, if you allow yourself to be vulnerable, you just create better connections with people, and they also start to open up, and you can create real good friendships, relationships. And then there are other people who don't want to talk about vulnerabilities, and that's okay. But perhaps that's not those people you're going to connect with. Trey, before we turn this, or I turn this into like a self-help therapy group, I wanted to talk about one of our mentors from afar, Warren Buffett. He said in this year's annual shareholders meeting that he would say that in the past 58 years, he roughly made, I think he said 12 good decisions, which is, let's call it one good decision every 5 years. And this comes from one of the most brilliant investors, if not the best investor in the history of the world. So to me, it was just mind-boggling. He said he only made one good decision every 5 years. But I can't help but ask, do you think that there's something to be said about that? Do you think it's the same frequency that you might have for Better Boots, or the past 11 years that would only make you, if you're as good as Warren Buffett, that would give you like 2 good decisions? So I don't know. I guess my question is, do you believe in that framework? And if you do, what are the 2 best decisions that you made?
Oh, well, that's a good question. I believe in the framework, but I also believe that Warren is very much underselling himself. And that, one thing that I've realized is that you're making decisions every moment of the day. And so even so much as deciding what to focus on, what to spend your time on. Buffett has decided every day that he's not going to use a computer. He's not going to book his whole calendar up minute by minute and fill up his time. He's going to spend it reading and digesting what he wants to study about. Those are minute to minute decisions that he's making that I would argue are very good for his purposes, especially. And juxtapose that to someone like Elon Musk. I just read his book, his autobiography, and that guy's going from space to cars to energy to neuroscience to, and every minute he's making a decision, right? People are pulling him in to say, hey, this. So it can look different, but it's still moment to moment decision making. And even as simple as just deciding what to focus on in that moment, in that day, is way easier said than done. I also heard this quote about Steve Jobs being one of the more focused people ever. And his line was, why are we talking about this? we're supposed to be focused on this, and I can't tell you how many times in my own business I've had that thought and maybe haven't been brave enough even to say it. Sometimes I've been a little bit more like, okay, let's see how this plays out. But everyone, when you get a group of humans together, they're all going to have their ideas. They're all going to have their ways that they want to contribute and collaborate. And just making that decision of being like, what are we talking about? Like, why are we talking about this? Like, let everyone look at this thing over here. Let's stay focused. These are all things that are easier said than done. The best decisions I've made, hands down, is starting this business with my wife. First and foremost, she is. It would never be where it is now without her. And I'm not just saying that. She's good at all the things that make the brand so great, and she could do my job, but I could not do hers, right? I'm more numbers and operations focused. She's actually building a brand, and connecting with our customers. She's on the head of our R&D team. So she's the one tasting, she's the one developing. So first and foremost, goes without saying, but that's the best decision I've ever made. The second best decision I've ever made is a tougher one. I'm trying to think of what perhaps that would be, but I think it's that we chose to manufacture the product ourselves. I think that's the best second decision we've ever made, because in beverage and food and beverage in general, that is very uncommon. People might think it's more common than it is, but at least in the US, everything sort of conglomerates, aggregates up to these co-packers, they're called, these places with heavy machinery and lots of scale. And, for a beverage business, it's like, why wouldn't you just plug into something like that and use someone who's already built the thing and making it more efficiently than you are, all these other things. And, for us, it comes down to just the quality of the product and maintaining a certain live culture that we want for Better Booch, for example, which is also uncommon. And just making sure. I mean, one thing, my favorite part of the day is going down to the brewery and taking a can off of our canning line and opening it up, and tasting it, and just right off the line. There's such a spirit to the business because of that. But it's been hard to maintain, and it's certainly challenged almost daily, economically and et cetera. This really proved to be a good decision in COVID, because when COVID happened, those co-packers prioritized their biggest accounts. Their productions were dropping off because people were out sick or whatever. They were running at maybe half the people, social distancing and everything else that got put in, mandated, and people lost their line time. It's called, because Coke and Pepsi were running their products, and that's all that got run. And your product was kind of left to the wayside. So we saw a lot of brands fall off during that time, whereas we were up and running and able to live on and continue to build our vertically integrated beverage company that also led to this acquisition and made it a successful one, because we were able to take that brand, let their lease go, and take on the production of it because we have our own manufacturing. So I think that's definitely the second best decision we've made.
Thank you for sharing, Trey. One of the investors that we follow here on the show, that's Nick Sleep. And Nick Sleep is very famous for his destination analysis of a company. He talks about how important it is that you can see into the future and sort of like try and take it back to today. And can you come up with the steps that are required to get to that destination? I would like to take Nick Sleep's framework and give that to you. And perhaps if you could talk to us about where's Better Booch in 5 years, and how are you going to get to that destination?
Yeah, well, what's exciting to me is that I went from wearing my operator hat to now wearing an investor hat, with this acquisition. So in a very, small way, our phone has started to ring, right? And people have noticed, seen the news and said, okay, well, and opportunities have started to kind of come across my desk. And that's been really fun for me, because as you know, Stig, as much as I love being an entrepreneur, I also love being an investor. And I'm really excited now that going forward, I have maybe more of an opportunity to juggle both of those things. And I think in 5 years, Better Booch will be a family of brands, a house of brands, nothing crazy. I don't think we're going to go buy any insurance companies and, continue on, but you never say never, I guess. But, I think we're going to stick to our circle of competence and food and beverage, and probably be okay with just a handful of something very manageable, that all kind of serves a different need. And that to me is very exciting. Also, I should say too, we have this, new vision for Better Booch and the brands we're looking into, where something I've actually, some realization I've come to recently is that, the microbiome is actually a stock portfolio. And what I mean by that is, you have trillions of organisms in your stomach that are doing all these functions for you. But something I actually just only realized recently is that this idea I had 5 years ago or so is happening today, where clinical studies are coming out almost every day, taking different microbes from, that exist inside you and proving their effect. So for example, serotonin is actually developed in your gut, the happiness chemical, right? So, and so they're proving out how, balancing your microbiome actually impacts mental health. They're finding that it can treat ADHD, it can treat Alzheimer's, it can treat all these physical ailments also that, like MLS, autism. So I'm really excited about helping take food and beverage into the future with more personalized products, more personalized beverages, what have you, that cater to your exact need. And maybe, it's boiled down to 4 or 5 needs that we fit into. Um, but it's sort of like this idea, like if you're heavily concentrated in one stock and that stock does poorly, your portfolio is not going to do too well. And in the same way, if you're constantly just eating sugar and this candida yeast that you have inside you is just on a feeding frenzy from that and overtaking, it's going to cloud your mental health. It could have all these incredible health effects that we're learning about. So you have to rebalance, right, Stick? You got to rebalance the portfolio, and we're excited to take this science that's actually now coming out and developing products around it and taking beverage into the future.
Wonderful. Well, Trey, I can definitely say that Better Boots is the best kombucha that I ever had. It's absolutely fantastic. So I just want to endorse that. I don't know if it's worth anything. Not that I'm a kombucha expert, but as an investor, I think it's so interesting to hear about the journey that you're on as a kombucha drinker. I can say that yours are the best. But I want to throw it back over to you, Trey, here. Like for those in our in audience who like kombucha, where can they get their product? But also, can they stay in touch with you? Can they sign up to the newsletter? You talked about here in our call about like where they can learn more about like the investing side of things. Like, yeah, where should the consumer go? Where should the investor go?
Well, first of all, thank you for that. Thank you for that endorsement. And it's been a real honor to have these opportunities to, collaborate and bounce ideas off each other and learn from you. And I just really appreciate the time we get together. And for those who want to know more, go to betterbooch.com. We have this new line I have behind me called Cha, which is a sparkling tea line as well. So it's not kombucha, but it's kind of a step above, sparkling water. It's very light and same kind of health benefits. We have live soda now, which is livesoda.com. And we'll probably package all this together under one roof at some point. But right now, we've got a few different brands to choose from, and I think you'll find what you're looking for even with those.
All right, fantastic. Well, Trey, I hope we can bring you back. Let's say whenever you make another acquisition.
Thank you, Steve.
Just joking. You're always welcome to come back on the show. Any concluding remarks here before we end this special episode?
Just that I'm grateful for you, Stig, and that I really value TIP and the service you guys provide. It's something I personally benefited from long before I was a host, and kind of expanded upon as from being a host, and now I'm seeing the benefits just continuing on in my own business. So I really appreciate the time.
Well, thank you. Thank you, Trey. I really appreciate that. Okay, so let's just end the episode here on that note. And we will probably be back here soon on the channel with another episode.
We're really drawn to one-of-a-kind, unique companies because our view is if you're going to do all that work, and we do a lot of work over the years, wouldn't it be great to own companies that get more mispriced in both directions? I think, to a small extent, that is one of the sources of our outperformance over time.